Hello, everyone. Welcome back to the channel. Before I begin, my disclaimer, as always, is I am not a life insurance agent, nor am I a certified financial planner or any financial professional. I am just a guy that really likes personal finance, whole life insurance, infinite banking, velocity banking. I would appreciate it if you would subscribe to the channel if you want to hear more about just alternative finances in general. Today's topic is whole life insurance, the best risk mitigator that exists in the marketplace. I am not 100% sure. I would like this to be a collaborative video where you let me know your thoughts below in the comments, but I think that whole life is one of, if not the best, risk mitigators that exists, at least with what I know now, and maybe I'll change my mind. But the reason why I think this is because there's a whole lot of things that we do in life that um, have risk, even though we may not very well be aware of these risks. Okay. And so you think when you talk about investments, now, when you think about investments, most people talk about average rates of return. And I am not going to necessarily talk about the difference between average and actual and how average rates can sometimes be skewed. Let's pretend that the average is indeed just going to be a constant amount. But the thing is that average does mean that some years the market will go up a lot, some years it will go up a little, some years it'll go down a little, some years it will stay the same, some years it will drop, and so on and so forth until you have your average rate of return. You think about real estate. So, in real estate, you have a lot of risk. You have interest rate risks. You have credit risks. You have tenant risks, let's just say. You have big repair risks, etc., etc. In life, you have income risks. I mean, you name it, risks are endless. All right. And so, why and how can whole life assist us? So, traditional rules would typically say that you need savings of 3 to 6 months of liquid cash in the bank. I don't disagree with this. And I know that there's some other infinite banking YouTubers, I guess, that say that you should have this in pure liquid cash. Um, I don't know if I necessarily agree with that. I think that you should save up to 3 months before starting IBC and then funnel your 3 months into your IBC policy. That would certainly be what I would slowly start to recommend. Uh, Over time, of course, so you can capture the lost opportunity cost that exists. But you think about this. Let's go through these risks one by one. And since we talked about an emergency fund, we'll talk about life because that emergency fund is typically for life. It's typically the idea is if you lost your primary source of income. Well, first and foremost, with infinite banking, the idea is that when you earn dollars, you take these dollars and you place them into a whole life insurance policy. This is your IBC policy. And then the idea is when you want to use these, you borrow them through loans and then you go and make investments from them. And then ultimately, the money that you make from these investments goes back to pay the loan and so on and so forth. And you just continually repeat this process, and you can replace investments with spending in general, I guess, right? And the idea is your whole life policy grows at a rate, typically, let's say 3 to 4.5%. It really depends over time. And so you have compounding growth that goes up. And of course, your interest costs are simple. And so they either remain the same relative to how much you've borrowed, of course. So they may be high, they may be low. It doesn't really matter. Um, And you think about this. If you lose your job, well, what will happen? Well, you need to rely on your money. Okay, well, if you deplete your money, that money is now gone. It can no longer work for you, even in savings. Um, and using your savings or your infinite banking for an emergency fund purpose would yield the same result. However, your money would still be growing. Now, the idea is if you've lost your job for more than 6 months, there's a bigger problem. But my point is that your emergency fund and your whole life insurance policy can be equal. So I think that is a win. There's no further risk in using an infinite banking policy. When you're talking about real estate, the biggest issue with real estate is that your expenses are very, very large depending on what comes. If you have lost a tenant, that could be thousands of dollars. If you can't fill a unit fast enough, that's thousands of dollars. The credit impact, if you don't make your payments on time, that could equal to be thousands, hundreds of thousands of dollars of lost opportunity if you can't obtain financing. I mean, you name it, it is there. And so, what a lot of bigger real estate investors do is they will have essentially, they'll have a piece of property. So they'll have a property that has a value, and then they'll have a mortgage. And then people think of this in one of two ways. So they'll either have cash reserves, or they'll end up securing a um, a home equity line of credit to the property. Now, a lot of people are very fearful of home equity lines of credit solely because of the fact that they can be called. They do have terms. I mean, you name it, there is a lot of restrictions on these. And so you can have the same benefits. So the reason why people like home equity lines of credit is because they don't need to put up the capital, so they can deploy their capital elsewhere. And the reason why people like cash reserves is because it is solid and secure. And so, with whole life done via the infinite banking concept way, or at least approach of designing it, you can actually you kill two birds with one stone. You have now effectively have a cash reserve that you can access at any time, and you have recaptured the lost opportunity cost that you lose with cash reserves, or that you otherwise you lose interest, okay, because your money's not earning money. So uh, it can be phenomenal. So if you lose a tenant and you need to make um, mortgage payments, you just go to your whole life. Okay, do it. And then there's no terms. You don't have to worry about it. You could not pay it back, at all, or you could not pay it back for 3 to 6 months. But of course, in good IBC fashion, you have to be a good banker and pay yourself back over time. So that's phenomenal. But where I think for the average person, because obviously, real estate investors love the infinite banking concept, and an emergency fund, of course, is just an emergency fund, whether it's cash or whether it's an IBC, um, it's going to be roughly the same. But in investments, especially for the average investor who's got their money heavily invested, imagine you go through life. So let's just kind of look at the growth of a money. Okay. Let's say this is retirement and this is when you start. Okay. Your money over time will grow. Of course, that's not really that exponential, but you get the idea. Well, the idea is this average rate of return is going to end up being we'll say 8%, but again, the average investor gets much, 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 much less than that. But let's say near retirement, what happens if the stock market drops? Now, the stock market will recover and typically recover kind of past this. Well, okay, that's a little exaggerated, but you get the idea. But the issue is let's say if you have $1 million, okay, and your goal is to withdraw, I don't know, let's say $50,000 per year, okay, and let's say the stock market loses 30%, so now your investment is down to $700,000, and then you go and withdraw $50,000, $650,000. Well, that means you have $50,000 less to help you get back up to this $1 million of money, and thus your return, your real return at the end of the day is going to be lower than it would have otherwise been if you could have just kept that $50,000 in this main pot, so that when the market does recover and has that 20% year, you're going to capture 20% on $50,000 as well as the 650, right? So This is where whole life can come into play because let's just say you need to withdraw $50,000 and the market's down 30%. Well, you can leave your whole $700,000 in there. You can then take your whole life policy. You can borrow, even if it's a policy loan, and let's say the interest rate is going to be 6%. Okay. You can then borrow your $50,000 and pay 6%, even let's say it's over a period of 2 years. Okay. And allow your money to recover back up. So to pay 6% on $50,000 is going to be a whole lot better than losing the opportunity of earning 20%. I'm picking 20% on my butt. I have no idea what it would actually be, but on the $50,000 in the recovery in the stock market. So this allows you to essentially just have a very big layer of protection that's in place. This does require some planning, though, of course, because you do need to have some projections to determine, how much money do I project I'm going to have? How much money do I think I'm going to withdraw on a yearly basis? And then what I would do is I would personally try to aim to have 2 times that amount in a whole life policy. Depending what age you start, of course, you can play with actually how much that will cost, how long you need to fund a policy for, you name it. I hope this makes sense. Let me know what you think. And also let me know what other areas you think whole life insurance, because the infinite banking concept really has little to do with um, the idea of risk mitigation. It's more about the actual product of whole life. And I mentioned infinite banking because that's typically how these high cash value policies are structured, right? Or at least they're structured in a similar way. But let me know in the comments below if you agree with me, disagree with me, if you think there's any other areas where whole life really adds a massive hedge. I know in the business world, it is beyond endless. I mean, you talk about suppliers, you needing to put in big orders. You've got accounts receivable issues. I mean, the list goes on and on and on and on. It's a phenomenal product that I don't think enough people utilize effectively. Anyway, we will catch you in the next video. Cheers. Bye.